You're sitting in front of the TV, flipping through the news channels, when you see a headline that grabs your attention. The stock market has crashed. But what does that really mean? Is it like a plane crash, where everything just stops working? Or is it more like a storm, where the market gets shaken up but eventually recovers? You might be wondering, why do stock market crashes happen in the first place? Is it a flaw in the system, or just a natural part of how the market works? And here's the surprising part. Stock market crashes are actually more common than you think, and they can happen for a variety of reasons. As you delve deeper into the world of finance, you start to realize that a stock market crash is not just a random event, but rather the result of a complex interplay between economic factors, investor psychology, and market mechanisms. So, let's take a closer look at what happens when the stock market crashes, and why it's not just a simple matter of the market going up or down. By understanding the underlying causes of a crash, you'll be better equipped to navigate the markets and make informed decisions. To learn more about the inner workings of the stock market and how crashes occur, keep watching. Vocabulary: volatility, liquidity, valuation, leverage. You're sitting in a crowded auction room, watching as a rare item goes up for sale. Let's say it's a limited edition art piece. As the bidding begins, you notice that many people are eager to buy it, and the price starts to rise rapidly. This is similar to what happens in the stock market when a particular stock is in high demand. The price goes up as more and more people want to own it. But here's the thing. The price isn't just determined by the actual value of the item, but also by how much people are willing to pay for it, driven by their emotions and expectations. And as long as the sentiment in the room remains positive, the price will keep going up. However, the moment the sentiment shifts and people start to doubt the item's value, they begin to sell, and the price rapidly drops. This is essentially what happens in a stock market crash. A sudden change in market sentiment leads to a rush of selling, causing prices to plummet. And here's the surprising part. It's not just the people who are selling that contribute to the crash, but also those who are trying to buy, but can't, because the price is falling so quickly. You start to realize that market dynamics are a delicate balance of supply and demand. And when that balance is disrupted, the consequences can be severe. As you watch the auction, you begin to understand how this same principle can apply to the stock market, and how a shift in sentiment can lead to a crash. Vocabulary: sentiment, dynamics, auction, plummet. What happens when you're investing in the stock market using borrowed money? Essentially amplifying your potential gains, but also your losses. You're essentially taking a bigger bet, hoping that the stock will go up so you can pay back the loan and still make a profit. Think of it like buying a house with a mortgage. If the house value goes up, you can sell it, pay back the loan, and keep the profit. But if the house value goes down, you still owe the full amount of the loan, and you might even owe more than the house is worth. It's similar with stocks. When you use leverage or borrowed money to invest, a small drop in the stock price can lead to big losses. And here's the surprising part. When many investors are using leverage and the market starts to decline, it can create a cascade of sell orders. Imagine you're on a plane, and the pilot announces that there's going to be some turbulence. A few nervous passengers might decide to put on their seat belts, but if the whole plane is filled with nervous passengers, everyone will be rushing to put on their seat belts at the same time, creating a sense of panic. That's what happens in the stock market when many investors are leveraging and the market starts to decline. The rush to sell can accelerate the crash. You start to see how this can create a snowball effect, where the market decline itself triggers even more selling, and that's when things can get really out of control. Now that you understand the role of leverage and debt, let's see how this fits into the bigger picture of market crashes. Want to keep understanding the inner workings of the market? Vocabulary: leverage, debt, cascade, turbulence, acceleration. What happens when a stock's price starts to fall? And investors who bought on margin get a margin call, demanding they pay back the loan or sell some of their stocks to cover the loss. You're sitting in the cockpit of the market, watching as the price of a stock you own starts to drop. At first, it's just a small correction, but then you notice something surprising. As the price falls, more and more sell orders are triggered, not by human investors, but by automatic trading systems designed to limit losses. These systems, often using complex algorithms, are programmed to sell when a stock's price reaches a certain level. And as they do, they can create a cascade of sales that drives the price down even further. And here's the part most people don't know. This can create a feedback loop where the falling price triggers more sell orders, which in turn drive the price down, triggering even more sell orders, and so on. It's like a row of dominoes, where each falling domino knocks over the next, creating a chain reaction that can be difficult to stop. As you watch, you start to realize that this mechanism can turn a small correction into a full-blown crash, with prices plummeting in a matter of minutes. You're starting to understand how the market's own mechanisms can sometimes contribute to its downfall. To get a deeper understanding of how this works and how it can impact your investments, keep watching, and let's dive into the next part of the story: vocabulary, leverage, margin, algorithm, feedback. What role do economic downturns, interest rate changes, and global events play in a stock market crash? To understand this, let's take a step back and look at history. You're sitting in a library, surrounded by books on past market events, and you start to notice a pattern. Many stock market crashes have been preceded by economic downturns, such as recessions or depressions. For example, the 1929 crash was followed by the Great Depression, and the 2008 crash was triggered by a housing market bubble bursting. And here's the surprising part. These economic downturns often have a ripple effect, impacting industries and companies in unexpected ways. It's like a row of dominoes, where one falling domino can trigger a chain reaction. Interest rate changes can also play a significant role, as higher interest rates can make borrowing more expensive, reducing consumer and business spending. Global events, such as wars or pandemics, can also contribute to market instability. Understanding these factors can help you see that stock market crashes are not just random events, but are often the result of a complex interplay of economic forces. By recognizing these historical patterns, you can gain a deeper understanding of why stock market crashes occur and how they're often linked to broader economic trends. As you close the books and leave the library, you feel like you've uncovered a crucial piece of the puzzle, and you're one step closer to understanding the intricate mechanisms that drive the stock market. Vocabulary: recession, domino, ripple, instability, pandemic. So, you're sitting in front of your computer, watching the stock market fluctuate, and you're wondering, why do stock market crashes happen? You've now seen how a combination of factors, including sentiment, leverage, and economic conditions, can lead to a perfect storm that causes the market to crash. It's not just one event, but rather the result of many interconnected elements that ultimately lead to a tipping point. Think of it like a row of dominoes. When one falls, it can trigger a chain reaction that's hard to stop. And here's the surprising part. Understanding how these factors work together can actually help you navigate the markets with more confidence. You're no longer at the mercy of unpredictable events, but rather, you're empowered with knowledge. You see, stock market crashes are not mysterious events, but rather a natural consequence of how markets work. With this understanding, you can make more informed decisions and avoid common pitfalls. If you want to learn more about how markets work and stay ahead of the curve, consider subscribing to our channel for more explanations that will help you decode the world of finance. Vocabulary: volatility, leverage, sentiment, empowerment.